Hello and welcome to a special show on the inflation data which are there on your screen. You can see that February CPI has come in at 3.21%. This is compared to 2.75% which came in January. While we are waiting for more details, let's also connect with our eminent panel. We have Indranil Pan as well as Aditi Nayar to decode these numbers. First, Aditi, I want to come to you. The headline number has come in at 3.21%. How do you read it? Wide anticipation was there that it will be over 3%. Do you think it is in line?
Yes, thank you so much. It is in line with our expectation. We had actually projected the headline CPI inflation for this month at 3.2%. So this is very much in line. I haven't been able to see the disaggregated numbers yet, so not sure if there is any difference in terms of the line items, but the headline number is very much in line with what we had projected.
All right, I want to take your view as well. In the Neela, we can see that the few food inflation numbers are also out, and on your screen, while the headline number is at 3.21%, the food inflation numbers are also over 3%. In fact, it has come in at 3.35% versus 2.11%, which was there in the month of January. How do you read these numbers, Indranil?
I think it was anyways, even with the old index, I think the food inflation was supposed to have been going up because of the base effect. So that's in line. The weightage for food, of course, is lower, which necessarily means that even as food inflation goes up, the relative hit on the CPI will be lower than what it would have been otherwise in the previous index. But with food at 3.35%, what it also tells me, and given the headline at 3.2, the core inflation must be quite a relatively lower number. And that, I think, is a positive for the economy from the inflation perspective, but may not be a positive from the economy from the demand perspective as well as the growth perspectives. So these are some of the things that I think the RBI would have to sort of juggle as it goes along.
Right, so the number has come in at over 3.21%. All the viewers who have joined just now, food and beverages inflation at 3.35%, pan, tobacco and intoxicants inflation at 3.49%, and that is as compared to 2.86% which was there last month. While we are waiting for more data regarding the inflation, Aditi, the major factor which everybody is worried about, the war impact is yet to be seen. How do you see these numbers vis-a-vis what is expected in the next month?
See, the food number is a little higher than what we would have thought, but then the counterbalancing factor is that core is actually a little bit lower. So we're starting off going into the conflict in West Asia from a slightly lower core inflation than what we would have, what we had projected before seeing these numbers. So it's an interesting sort of mix. Of course, everybody has been saying the same thing. I'll just end up repeating it. The duration of the conflict is what really is going to determine the numbers for this month, this quarter, and the year ahead. So, you know, there's a lot of ranges that we're working with in terms of what could be the impact on growth, on inflation, on the current account deficit, and on the fiscal deficit for every sort of $10 average increase in crude oil prices. It's not just the prices, it's also the availability which matters. So, for instance, looking at the kind of tight supplies of LPG, that is something that if it prolongs and availability doesn't improve, then that would have an impact on things like the restaurant sector. And that is, you know, there are some parts of output where if you have a break, if you have a crisis which is there and the output isn't produced, then it may not actually, there's no catch up later. Whereas for other items, even if you have a break in the production, you catch up to it later on. So anything which has a longer inventory cycle, even if you have a temporary issue which is there, you can catch up to it later by producing more inventory and by, you know, pushing out your inventory faster, ramping up your production basically. But there are parts of the service sector where a loss is just a loss. So we're definitely hoping that there will be a resolution both to the crisis and to the availability issues as far as India is concerned very, very soon. Now looking ahead, basically one of the rules of thumb that we're working with, if there is an average increase of 10% in crude oil prices, If there is full transmission of that to RSPs, then the CPI inflation would go up by 30 to 40 basis points. This is just a scenario. This is definitely not the baseline that we're working with right now.
Right. Indranil, how do you see the situation because it is changing very fast on ground? Of course, we are seeing that LPG non-availability and all those things. Do you see that this into translating into the longer term problem for inflation, or you think that this will have limited impact considering the last month numbers are not too bad?
Well, I think Aditi has sort of highlighted most of the important factors. Just to add, for me, I think the bigger and the more crucial element is even beyond the war. I think I'm slightly worried about the currency dynamics. Now, even if the war ends, it will be quite a while before the imports and the export side that goes to the Straits of Hormuz normalizes. So that's something that we need to sort of be carefully assessing. And secondly, the capital flows because of the crisis issue. I think the capital flows to the emerging market economies, including India, that has been on the lower side, will continue to be on the lower side. The impact of the West Asia crisis on the growth and the inflation and the overall macro perspective for India. Yes, even though the starting point for India in terms of growth and inflation is relatively healthy, if projections of FY27 GDP are just about 7% going down from a 7.7 to 7.8% in the current year, that will obviously have its implications in terms of the capital flows. So for me, irrespective of the war continuing or ending, I'm slightly negative on the currency side, which will manifest itself in terms of inflation pressures domestically. Higher input costs, higher landed costs for manufacturers, higher costs in terms of fertilizers and other agricultural input costs, which obviously has to gradually get passed on to the end users. So from that perspective, I think inflation is heading higher. Immediately, very difficult to say because of the new series. It's very difficult to sort of calculate what is the momentum perspective in terms of what is the actual number on the inflation. But I think if from the previous series we were looking at a 3.8 to 4%, in the current series the upside could be anywhere between 32 or 50 basis points.
All right, so that's the assessment which is coming in as far as impact is concerned. There are more constituents which are on your screen. Restaurants and accommodation services inflation at 2.73%. There is also urban and rural inflation both over 3% as I read currently. If you would have seen the headlines inflation numbers compared to what was assessment, it is coming completely as per the anticipation. Now, the obvious question is when Reserve Bank of India will be meeting and seeing these numbers, and also there is a time lapse of 2 to 3 weeks whereby the situation which is unfolding is also a little bit uncertain. How do you think that monetary policy will be shaped? Aditi, to you?
So before that, our baseline expectation, if we just set aside everything related to the war and the conflict, when we go from the old base to the new base, our sort of assessment was that the average CPI inflation in FY27 would have been around 4%, but the curve would have been flatter instead of steeper as we would have expected on the old base. And I totally take what Indranil is saying. I completely agree with him that I think currency pressures now would be there. Even if there is a quick resolution to the conflict itself, currency pressures would linger for longer, and I think that is going to lead to some amount of inflationary pressures that we need to contend with. Now, coming to the monetary policy side, I think we have about 3 weeks before the next policy meeting, and that's a long time in geopolitics these days. So let's hope for the best before the monetary policy meeting. My sense is that this is going to be a pause policy. It would have been a pause policy even without the conflict, and I think that would be possibly appropriate at this stage, given the fact that we don't know how long things are going to stay in crisis mode, and therefore what will be the lingering impact on inflation. While I agree that this is going to lead to slightly higher inflationary pressures, even if the conflict resolves, but it may not be enough to really lead to a rate hike very quickly. So possibly a prolonged pause and a meeting by meeting assessment of what's happening on the ground would be appropriate, especially given the fact that we're also, we have a new series for both GDP and CPI, and the dynamics of that, the projections we need to fine tune.
Right. As far as the constituents are concerned, I will once again go through the release which is there. The food and beverages is of course at 3.35%, pan tobacco and intoxicants at 3.49%, clothing and footwear at 2.81%, housing, water, electricity, gas and other fuels has come in at 1.52%, health is at 1.9%, transport at in the negative territory of 0.05%, and information communication has come in at 0.25%. Apart from that, recreation, sports, culture at 2.21%. So overall, even the restaurants, accommodation and services has risen by 2.73%. Most of this seems in line, but if I talk about personal care, social protection and miscellaneous goods and services, it has come in at 19.64%. Overall, any of the constituents gave you surprise, Indranil, to your reading?
Not really, because we were anyways expecting 3.3% as the headline number. The constituents also seem to be in order, and more or less the momentum of the previous month has sort of continued. We anyways were expecting a higher number on the social, because of the gold prices. The 19% is also not really a surprise. It was also about a 19% at the last reading that we got in January. So overall, I don't think there is any clear element of surprise even in the internal numbers.
Right, and Indranil, to the question about how will Reserve Bank of India read these numbers, and plus the uncertainty of 3 weeks, which is very difficult to determine and take the case. But for sure, can we expect that inflation, the target, what I mean to say, the projection which was given last time, there will be some kind of tinkering upwards in the next monetary policy, and similar, what is your view on even GDP growth?
So inflation number, I think the RBI will come out with a new inflation numbers based on the new series. So we'll have to see what is the thought process of the Reserve Bank of India at this point in time. Growth projections for the next year, anyways, as I said, we were looking at around 7% compared to the 7.7 to 7.8% of the current year. So growth definitely goes down. From an RBI's perspective, the uncertain times, the uncertainty levels are such, and especially more on the inflation side rather than the growth side, because growth to a significant extent will also be domestic based. It is judicious and prudent for the RBI not to touch the rates at all at this point in time, and even not signal anything. So neutral stance is something that we continue to expect. So for April and June, we continue to expect no change from the Reserve Bank of India. Now, if the crisis continues for a longer period, previously we were expecting the RBI to be on a pause for a longish period of at least 12 to 17 months. That to a certain extent may actually come down, depending on where the inflation is and where the currencies tend to move. So a lot of things need to be taken into consideration by the Reserve Bank of India at this point in time before they actually do a change to the current policy structure.
Right, and Aditi, if at all it was expected that there is some room for easing for Reserve Bank of India governor, now that is gone for sure?
We were really not expecting any more easing. We thought that the prolonged pause had already started, and for sure now no easing expected at this point in time.
Right. One final view I want to take from you, Indranil, before we wrap. Now the inflation numbers seems well in line. The uncertainty factor, it is difficult to predict. Overall, from a macroeconomic point of view, do you think there is some cause of worry, or you think we are very well placed?
I think, as I said, our starting point is good, which is a high growth and the low inflation. So we will see relatively more balanced growth and inflation, in my opinion. 7% growth is not bad, given the fact that the economic survey also pointed out that the potential growth for the economy is at 7%. And also a 4.5% inflation is not bad, given the target that the RBI has. If any worry comes to my mind, it is relatively more on the external sector. And as I pointed out, we are expecting, if the crisis continues, we are expecting the CAD to increase and capital flows to be lower, which necessarily means that the balance of payments continue to be in the negative for the third year in FY27, which necessarily is a negative for the currency. And the other worry that I have, though very difficult to highlight at this point in time, is that to prevent the pass-through from the higher oil prices or the landed cost of crude to the end users, the fiscal will through the reduction in the excise taxes on petrol and diesel, or in terms of fuel subsidies to the, and the fertilizer subsidies also possibly needs to be on. So all taken together, the worry is more on the fiscal and the current
Definitely,
account,
definitely,
and the
Indranil.
overall external balances.
Definitely, Indranil, point taken. Thank you so much. I have to cut you regarding because there was some technical glitch which has happened. But for now, thank you so much, Aditi, as well as Indranil, joining with your views on the inflation numbers which has just come. Overall, seems in line. Now it will all depend how the West Asia crisis is unfolding and what are the cues which Reserve Bank of India takes from the same. But for now, it is time to take a very quick break. After the break, a lot coming up.